Today's overlooked stock is Winnebago. George Tsilis, our senior markets correspondent, not so overlooked out there in the West, GT, as you guys got ranges and mountains and a good environment for the RVs. Stock, though, getting a fresh little rip here. How come, GT? What's up?
Yeah. Well, I think, we got a lot of open range out here, by the way.
I know. Don't rub it in, man.
Look, Winnebago, we know that they're famous for RVs and recreational vehicles, campers, trailers, and so forth. They do own the Chris Craft Boat Company as well, so they have diversified, product line. And from a manufacturing standpoint, we know that the leisure and travel business was shut down during a pandemic, so everyone was very, very apt to purchase, Winnebago-type products and campers and trailers. But that was sort of a 21 and 22 year-based push, and now things have normalized, and the stock itself over the past year, albeit again it's higher on a year-to-date basis, is actually down over the last 5 years, considering the huge demand post-pandemic. Now, today's move really wasn't based on earnings. I'll talk about it quickly, but if you go back to the 23rd of October when they posted earnings, they actually missed sales estimates just fractionally, and sales were down 6.5%, as well as earnings per share, which were a miss and down about 12% year over year to 28 cents. But if you look at the stock price, it did dip on the 23rd. It's actually caught a bit in the last week or so. Now, some of that could be certainly based on the the Trump administration push that the markets have received over the past week or so. But it also might be a function of interest rates expected to come down. Plus, I think it has also to do with the fact that if you look at the earnings profile for Winnebago, next quarter looks like the low point at the very least for the next 6 quarters. They're estimated to earn on an adjusted basis only 22 cents. And henceforth, like I said, the next 5 quarters after that, it looks like earnings profile seems to be improving. So it's actually trading quite well. It's been in a trading range somewhere between 80 and 40 in the past 5 years, outside, of course, the pandemic drawdown, which lasted a very short period of time. But the entire time, the company's actually been paying a pretty generous dividend. They're paying about $1.36 per share on an annum basis, which is about 2.5%. But the other catalyst today was, North Coast Securities upgraded the stock in terms of price to buy from neutral, price target now from $60 to $75. And then they also see what I see, which is improving earnings profile, improving sales, which if you look at the last quarter reported, we're down 6.5% for the full year. In other words, the 3 quarters cumulative prior to the earnings release on the 23rd, sales were down 15%, earnings was down 45%. And going forward, the sales estimates are quite conservative to low, down 2%, and earnings are expected to be down 11%, which is significantly lower than their 5-year average. But the stock price, again, has maybe priced in the fact that earnings contraction and revenue contraction might have found an inflection point.
Okay. All right. So, the earnings picking up seems pretty good. The potential for travel, and spending is definitely there. But maybe corner being turned, rather, from Winnebago, which you do have to do kind of slowly in those things.
Very much so. But here's the thing, if you look at sales, last year they were down 16 or so percent. Earnings growth was down quite a bit, 45%, but they actually still eked out a profit, albeit again, it was a small one. On sales of about $1.8 billion, they earned on a net income basis only $13 million. If you just go back to 2022, which is actually their best year because it took some time to ramp up production with the huge demand, sales were higher by $3 billion, around $4.9 billion, and they actually generated around $320 million. So, this whole time they've been profitable. It just happens to be that profit growth has retracted. Price action is also, not fared great, but it hasn't fared poorly either. But at the same time, like I said, it looks like earnings growth estimates outside of next quarter seem to be improving on the next 6-quarter basis. Short interest, too, is quite high on this name. Kind of surprised by that. It's around 17% of the free float. They pay a dividend. And like I said, it looks like things are improving for the business because in the past year and a half to 2 years with higher rates and demand, going down as well as supply, a lot of folks who bought during the pandemic realize how much troublesome these products are to maintain and store and so forth. There's a lot of inventory going in the marketplace. They actually have been cutting back operating expenses and then right-sizing their expenses. So for what it's worth, it seems like maybe there's an inflection point manifesting here in the stain.
All right, cool. Does look like the chart, the technicals kind of have that like double bottom thing going on.
Yeah.
So, all right,
Yeah.
you know what they say, if the Winnebago charts are rocking, don't come a shorting. All right.
Sounds good, OJ.
Thanks, George.